we could probably get started. Publius, do you have anything to say before we get class started?
So, not anything in particular worth noting. If you want to continue to get involved in the DAO, reach out to Dumpling. The DAO continues to grow incredibly quickly, which is very exciting, and the hope is that the increase in the organizational structure over the next couple weeks will greatly increase the output from Beanstalk Farms that is independent of Publius. And obviously, there's some sort of friction when people are getting onboarded and things like that. So the hope is that as things become a little bit lower friction, the output improves. And we're very excited about the quality of talent Beanstalk Farms is attracting. So if you are a high quality individual or know someone who is and want them to try to work on Beanstalk, happy to chat with them. So that's maybe the only announcement as the DAO continues to grow. But otherwise, happy to answer any and all questions. Obviously, we haven't been as active in the Discord recently as we were maybe a month or two ago. That's a function of the fact that there's so much going on in the Discord and in general around Beanstalk that we don't have that much bandwidth to respond to any and all things in the Discord, but have still been trying our best. So hopefully going to use this opportunity to get to anyone's concerns or questions or whatever is on people's minds. So without further ado, if people have stuff to say or add or ask, just feel free to raise your hand and we'll try to get you up here.
I had a question to start things off, I suppose.
How you doing, Evan?
Good, Publius. How's it going? So this is it's a question regarding the Bean NFTs, and I was just wondering, um, what your thoughts are on having the Bean NFTs denominated in Bean, and this might be a new question, but is it possible to do that on OpenSea? And if not, then thoughts on an NFT marketplace that denominates things in beans?
So that's a great idea. And in fact, something that is attractive to us to do as the Beanstalk Farms development capacities improve is to basically fork OpenSea and have like a bean denominated OpenSea for BeaNFTs, and then you can circumvent the OpenSea 2.5% fee and either reallocate that fee to like funding the BeaNFT DAO or removing it entirely. So there's a lot of wiggle room there. But the hope is to, given that most of the demand for BeaNFTs are going to be native to Beanstalk, if that makes sense, people who are already part of the ecosystem, there probably isn't that much of a loss of a network effect from moving the main exchange off of OpenSea. So yeah, that's a very attractive option to us.
I like that idea. And also if we could, the more things we could denominate in Bean would be pretty awesome.
I have a question, if that's okay. So I think I've wrapped my head around, the idea of how, requiring collateral with a stablecoin slows down the potential growth of the market cap. But I'm wondering with decentralized entities, like call it Circle or Tether, my understanding is what happens is whenever someone, wants to trade a US dollar for USDC, they figuratively click a button to mint one on chain. And so I'm curious if you have any insight, like more specifically, what makes that process difficult for Circle? Is it just that they can't possibly come up with the capital to back it up quickly enough? Or what exactly is it that makes that difficult for Circle?
So at the micro level, there is a lot of friction around KYC. And like, do you know anyone that's ever done what you're describing, which is take dollars and exchange them for Circle? The only people I'm familiar with that have done that in massive size, millions or tens or hundreds of millions of dollars at a time. And ultimately, that's the nature of the centralized issuance model, where it doesn't happen on a continuous basis typically. And the more macro reason why it's a problem and a friction for the market in general is that there simply aren't enough dollars that people are willing to lock up to meet demand. And so right now, basically nobody wants to hold dollars in a bank account. It yields basically 0% a year. And accordingly, there's a shortage of dollars that Coinbase has found people who are willing to lock up dollars in a bank account. And the result is that Coinbase has had to diversify their holdings. And so they're no longer holding just dollars, they're holding other assets as well. And that's reflective of the fact that there's simply not enough dollar. It's hard to put $1 trillion in a bank account. Simple as that. And when you think about just even on an Ethereum level, DAI or MIM or Liquidity, it's difficult to lock up $100 billion of Ethereum, right? There's a lot of other things you can do with your Ethereum, and even though there's a ton of demand to do that, at some point you run out of Ethereum, and that's where the cap and supply of a collateralized model ultimately comes from. So losing that limitation that is derived from the fact that there's simply not enough capital to support the stablecoin market in a way that there aren't egregious borrowing costs or opportunity costs associated with using your stable coins. That is almost entirely a function of a shortage of available collateral people are willing to lock up.
Okay, got it. So Coinbase doesn't have enough capital because people aren't willing to lock up enough dollars because there's so many other ways to gain returns. Is that how you think about it?
Correct. Like if you have $1 right now, is on the list of, if you have $100 million, let's put it this way, on the list of things that you're going to do with your dollars, where is leaving it sitting in a bank account? Where does that rank on the list? Right. And so in practice, and this is where things get a little finicky, Coinbase almost doesn't want to flood the market with USDC to bring the borrowing cost to $1, because then you would literally have no reason to add collateral, right? So it's, to some extent, that's where the market-based dynamic comes in, where the more demand that there is reflected in higher borrowing costs, which potentially makes it more attractive for people to give money to Coinbase. But in general, like, good luck issuing $1 trillion or 5 trillion USDC. That's going to be very difficult.
That makes a ton of sense. Thanks for the answer.
Hey, Publius. I've got a question. I guess I would love to hear more about the inspiration pulled from past like algo stable projects, and like more of, what are Beanstalk's unique improvements on some of those systems.
Compared to what? Which ones?
I think just past attempts at algo stables, so like ESD, DSD, basis cash, some of these.
So, in many ways, that's an open-ended question, because we could talk for hours and hours about the differences. But I think to give a couple of concrete examples where things are substantively different and how that has a meaningful effect on Beanstalk and its sustainability. The first one, which is most meaningful, is that the increase in the supply of beans when the price is above $1 is a function of the liquidity in the BeanETH Uniswap pool. Whereas ESD, DSD, basis cash, they would increase the supply as a function of the market cap, or the total supply, we should say. And so if the price was 1 cent too high, they would increase the supply by 1%, which is way too much. And when you combine the fact that when you have such egregious inflation, with the fact that there weren't many limitations on inorganic demand to ape into the system, when the price was above 1, you had massive rushes of capital into the system that caused it to overinflate, that caused more capital to come in, that caused it to overinflate. And whenever that ran out of steam, it crashed and burned. And so in many ways, the way that Beanstalk handles not entering a death spiral when the price is less than $1 is by not minting too many beans when the price is above $1. And so Beanstalk tries to mint beans in a more market-based than a true theoretical economics-based approach, which factors in the amount of beans that need to get sold on the BeanETH Uniswap liquidity pool in order to bring the price back to $1. And on the debt side of things, ESD and DSD are, and we're skipping over a lot of differences, but they're very different than basis cash on the debt side of things. So basis cash, and more of the basis model, which is more what we're familiar with than the specific basis cash implementation. The model is that there would basically be continuous auction windows where every certain period of time, I don't recall the epoch period, whether it was a day or an hour, what be it, basis would basically hold an auction where it would say, okay, we need to fill this amount of demand for basis, and so we have to fill it, so we're gonna allow the market to set that price and basically allow people to bid higher and higher, and whatever that closes at, the point is at least basis will be able to guarantee accessing enough demand. And that is, in a theoretical way, an efficient auction to ensure that basis gets the best price for filling the debt that it has to fill. But the trade-off that it makes as compared to Beanstalk is that basis says it needs to immediately attract that demand. And therefore, basis is willing to pay any price for that debt up to an infinite rate. In Beanstalk's case, Beanstalk is willing to move a little bit slower. And so while it issues soil, it's not willing to pay any price for that soil. The weather only changes a little bit every season. And that, as compared to basis, prevents it from overpaying for its debt. And as compared to ESD and DSD, on the debt side of things, ESD and DSD had a real tragedy of the commons issue, which, not to speak specifically of basis coupons in general, but which had separate issues, but the ESD and DSD coupons were particularly flawed, where they were redeemable at the same time. And so there was no preference for when you lent your money to ESD or DSD for when you could redeem. All bondholders were an equal class of bondholders. And the real problem with that was compounded by the fact that the interest rate that you would get for lending money to ESD or DSD was a function of the debt level. And as the debt level would rise, the interest that you would get for lending to ESD or DSD would also rise. And so they predefined an interest rate based on a debt level, which is sort of ridiculous in and of itself, but it also created this horrible economic incentive structure where even if I was incentivized to lend to ESD or DSD right now, I would actually want to wait for somebody else to do it so that I could get a higher interest rate because the debt level would go up between now and then, and I would get a higher interest rate. Whereas in Beanstalk, because of the first in, first out harvest mechanism and the fact that the weather is not changing radically between season to season, the incentive structure is, if I am incentivized to lend to Beanstalk right now based on the price, the weather, the debt level, etc., the incentive structure is that I do it immediately, because the risk that somebody else sows ahead of me and is now in front of me in line will have more an effect on my return, and therefore I'm incentivized, more of an effect on my return than at the margin the weather might improve by going up 6% over the next couple hours per se. So that's how Beanstalk creates a very efficient market around the debt side of things.
That's awesome. Thanks for answering that. It's cool to hear how thoughtful you guys were about building this. Thanks.
Hey, I also have a question. Mine is more so focused on, could you give a little bit more of an explanation on why a credit approach is superior to a collateral approach? And then the second question following that is, at the end of the day, this is linked to the USDC ETH liquidity pool. So could you explain a little bit more on how we are more decentralized or are decentralized and why that is the case with us, and how maybe that liquidity pool aspect doesn't contribute to that? Thanks.
So there's one question of decentralization, which is somewhat separate from the main benefits of a credit-based model over a collateral-based model. So with regards to the decentralization of the Oracle, Beanstalk derives a price for one bean from the Bean ETH Uniswap pool and compares it to the USDC ETH Uniswap pool. And therefore, Beanstalk can get a pretty good price for $1 at the moment, without any exposure to any centralized operator. How is that possible? In order for the issuer of USDC to ban Beanstalk's Oracle, they would need to blacklist the USDC ETH Uniswap pool, which would effectively make USDC more or less useless going forward within DeFi if they're just going to start blacklisting random AMM pools. And accordingly, it's highly unlikely, based on the potential actions of Circle, the operators of USDC, that that's going to happen. And when you look at Uniswap, when the government has sort of stepped on the neck of Uniswap to delist certain assets, what they've done is they've delisted it from their website, but never have delisted any AMM from their protocol. And so we look at and feel like, between the fact that the Bean ETH pool is trading against Ethereum, which is the native asset of Ethereum, and so in that Oracle model, you don't have any exposure to the actions of Circle when it comes to censorship. You do have exposure to their actions when it comes to like fraud or theft or losing their their collateral. But that's sort of a different type of exposure than a censorship risk per se. And to answer you substantively but succinctly on the benefits of a credit-based model versus a collateral-based model is to build off of our answer to Austin. If you have capital that you need to lock up somewhere in perpetuity in order to use a stable coin, and specifically you need to lock up an abundance of capital, 150%, 200%, maybe as low as 110%, but more capital than you intend to use. You need to lock that up. There's a cost associated with that capital being stuck there, specifically an opportunity cost. And that opportunity cost is reflected in multiple different places. But specifically, we see it in really high borrowing costs for the current available stable coins, which are all collateralized one way or another. And in short, when you switch to a credit-based model, what that does is it untethers you from the need to lock up collateral and pay that rent associated with locking up that collateral. So you have a one-time purchase of your beans, you take your capital, you buy beans, and then there's never any rent or future locking up of any capital associated with that. And the only capital that you're locking up, so to say, is the capital that you're taking and trading into beans, which you immediately then have as liquid. So there's no capital inefficiency there. And furthermore, when you then have the opportunity to deposit those beans directly in the Beanstalk protocol, you can then lower your cost of capital. So you start with one bean that you bought for $1, and now you have two beans. Well, now your cost of capital is 50 cents, but you still have two beans that can, hopefully in the next couple months start to be used throughout DeFi. So whereas with USDC, you take your ETH, you lock it, you buy, well, let's take DAI, right? You take your ETH, you lock it up, you're over collateralized, you're paying a stability fee continuously. In the case of Beanstalk, you just buy your beans, you deposit them in the silo, and now you're earning interest on that natively from the protocol. So just that dichotomy between a model where you're locking up your capital and paying continuous rent on it versus not locking up any excess capital and collecting interest on your beans, that's where you can most clearly see the difference between the two models.
Thanks.
Okay, Steven, and then I'm going to bring up Mr. Juice, who can be next.
Cool, thanks. I actually had two questions. The first is how, like you mentioned earlier that USDC, well, I guess like my question is like, how do you compete with USDC and DAI as like a stable coin in DeFi when their borrowing costs are so low?
Well, specifically,
Like
we
being like I'm trying to like imagine a scenario. So you said like USDC, for example, like US dollar, for example, like if you deposited it in a bank account, you'd be getting close to like 0% return, which also means like the borrowing costs is also pretty low. And in terms of like actually having usability for Bean, like if we have like a borrowing cost of like 20 or 30% or whatever it may be, like I don't think it's a very good option as opposed to some other stable coin.
So I have a question.
Yeah.
Where are you getting a borrowing cost for Bean?
Oh no. Well, this is like in the future that you maybe I'm misunderstanding, but like a potential future where Bean can be used in like DeFi.
So we'll try our best to address sort of what you've said here, but it's we'll try to piece it together.
Okay.
So in general, the fact that interest rates are so low doesn't necessarily mean that Circle has access to infinite capital. In any competitive market, capital is always looking for like an efficient place to be deployed based on the risk and return goals, right? And so Circle has to compete with every other potential use of capital that exists, basically. And the option to take your dollars and give them to Circle in exchange for USDC that you can earn, 9% on or something, and if you start to do that in size, you'll start to eat into your return, is only so attractive to so many people. And specifically, when you consider that that's happening basically in an OTC fashion where it's very few parties that are going through KYC in a non-continuous fashion, there's a ton of friction associated with actually raising capital to issue more USDC, even if like the underlying economics make it possible to issue more USDC over time. It's not possible to issue $1 trillion USDC in a short period of time, if that makes sense. And as a result, there's always going to be frictions associated with USDC. And just to restate it one more time, the main attraction of performing the ARB to give capital to USDC is to then take advantage of the opportunity to lend out the USDC on chain for some sort of interest native to some other protocol. And specifically, that behavior is only incentivized as long as that interest rate is high. And so a shortage of USDC is actually what keeps that market healthy. So a high borrowing cost to USDC is natural and is inherent to any sort of collateralized model. And that is reflected on the fact that if you go to a product like Aave right now, the cost to borrow USDC, on a stable basis are still double digits, 11.5%. Like, that's craziness. Whereas, and now to address your future scenario, we don't envision a scenario where there is ever a need to pay a borrowing cost borrowing costs of 20 to 30% to have beans, because you can always buy a bean on the open market, right? And so specifically when we talk about the structure of the interest in a USDC market versus a Beanstalk market, you take your USDC, you don't have to put it into a lending protocol or another protocol to earn interest in a protocol that is not native to USDC. In the case of Beanstalk, you buy your beans for $1 each, and then you can passively stake your beans in Beanstalk, in the protocol itself, and collect interest in a passive capacity. And so there shouldn't be, certainly when we think about efficient economic behavior, there should never be a scenario where people are paying 30% borrowing costs on beans. Because if that's the case, like the fact that Beanstalk isn't inhibited by a shortage of collateral, Beanstalk will just basically mint beans until the borrowing costs for beans are zero. And it will pay all of those mints to silo members and field sowers. So it literally takes all of those borrowing costs from the current stablecoin market and it pays it to Beanstalk farmers.
Gotcha. Okay, so I think I was misunderstanding. Yeah, like you said, like there's platforms that you can lend out your stable coins to. So in Bean's case, it's basically all within the protocol itself, is what I heard from you.
Well, just specifically the native interest earning opportunity. We do anticipate that beans, and more in a more sophisticated sense, stock and seeds. We have no idea what the borrowing cost for stock and seeds will be, or silo beans. But the perspective on the cost of acquiring a bean, beans can still be adopted in various borrowing protocols, but there should be near zero borrowing costs for beans in general. Now, some sort of time preference for locking up a bean for a period of time, like there's a cost associated with that just from an economic perspective. So capital isn't free, but in Beanstalk, it should be pretty close to free.
Okay, and sorry, I don't want to take up too much time, but one other question I had was how, like, I saw on Discord you mentioned that part of Beanstalk is like behavioral economics, and so I was wondering kind of like, you created the white paper, and I was wondering like how has like the actual protocol worked out differently from what you expected when you originally created the white paper, if at all?
That's a fabulous question. It's a little bit difficult for us to answer because of how much things have played out almost exactly as we have expected them to, and it's hard to talk about that without sounding either like we're lying or full of ourselves. But when we think about the launch strategy that we ultimately decided to go with, which was no pre-mine, no pre-launch, like to compare it to something like ESD, which said for a given number of epochs, the price will be locked in at $1.40 or something and guarantees some sort of inflation schedule. By deciding to go from zero, it did sort of expose Beanstalk to the type of pump and dump that happened in mid-September. And while we were a little bit surprised at how young Beanstalk was when it went viral on crypto Twitter and went through, the difficulty that was mid-September through mid-October, it was very much in line with our expectations. Now, did we see 24 cents coming when we launched the protocol? No. Did we see it when we saw beans at $4? That made a lot more sense given the immediate context that we were in. Now, not to claim that everything has gone perfectly. For example, BIP6 is a reflection of the fact that certain parameters can certainly continue to be improved, like the amount of soil that is available. And we intend to continue to tweak those parameters now that we have a ton of economic data to take into account. But at a macro level, the model is not going to change. And that's largely due to the fact that at a macro level, the model has demonstrated some sort of proof of concept and things have played out more or less in line with our expectations. Now, we have a lot more expectations about what the future looks like, and we don't count any of our chickens, and there's a tremendous amount of work that needs to be done to get from here to there. But thus far, things have been like almost in a magical way. Things have been, you can't call it smooth sailing, right? Because it's been very volatile, but we're incredibly pleased with the way the model has been performing in the real world.
Okay, thank you.
Steven. Next up, Mr. Juice.
Hey, so my question's kind of unrelated to Bean. Is that all right? But it's still about like the decentralized environment.
Go for it.
Sure. Go ahead.
Sure. So I'm soon to graduate, computer science graduate, got a job lined up as a software engineer, but I really want to build in this space, in the decentralized space. I was kind of wondering what advice you guys had for me to sort of position myself to learn a lot more and to be able to build a lot more.
Come work for Beanstalk.
I'd love to.
So we're serious about that. You should talk to us after class. In terms of, at a substantive level, crypto as an industry moves faster than basically anything, certainly anything we've ever experienced, but faster than almost anything else that exists. Where the state 6 months from now or in the past is just so radically different than today's state. And that's continuously the case, and that's why there are such quick cycles throughout the space. And ultimately, in order to stay on top of crypto, it requires you to be in it in some capacity. And so, at least what we have found is doing things in a hands-on capacity and just diving in and working on projects or forcing yourself to have an obligation to stay on top of this on a daily basis is really the only way to get up to speed and then b stay up to speed because of how quickly things ultimately change.
That makes sense. I guess I'll take you guys up on working for Beanstalk after this.
Fabulous. This is what we want to see in class, everybody. So everyone can come up here and get a job. All right. Who's
Love it.
next?
I have a quick right before you go, Ori. I have a quick question from Don, who just DM'd me. And earlier in the week in Discord, I promised I'd ask it. So, okay. So from Don, why is the weather so high and increasing when price is so close to 1? Why doesn't weather get close to 0 when price gets close to 1?
That's a great question, Don. So Beanstalk optimizes around price. And first and foremost, the goal is to get the price back to $1. But at a more macro level, if the price is at $1 and the debt level is 10,000%, that's not going to be sustainable in the long run. And so Beanstalk is trying not just to return the price to $1, but to return Beanstalk to ideal equilibrium, which is the price at $1 and the debt level at an optimal debt level, which is currently defined as 15%. And so even when the price is at $1 or close to $1, the weather is going to continue to increase in order to hopefully create at some point excess demand for soil to create a positive feedback loop that will start a deleveraging of Beanstalk and ultimately return its debt level to the optimal level. So the weather continues to rise because it needs to attract enough demand for soil such that there's excess demand for soil, which will cause Beanstalk to deleverage.
So following up on that, can you explain why an excess demand of soil will cause Beanstalk to deleverage? Can you walk us through that?
Definitely. So specifically, if we take into account BIP6 and how it affects the minimum soil, so when there's excess demand for soil, that is reflected in the fact that every season, all of the soil is sown. Beans are sown in all of the available soil. And just for reference, during like the 2.5 week period starting around Thanksgiving when there was excess demand for soil, Beanstalk was issuing too much soil. And accordingly, even though it was starting to pay off its debt in mass, it paid off like 15 million pods, the pod line increased almost 200 million pods during that time. And so even though it paid off debt, its debt level increased, its pod rate increased. And so BIP6 changes the amount of soil that is issued when there's excess demand for soil, such that, as an example, let's say Beanstalk paid off 100,000 pods at the beginning of this season. Accordingly, it will only be willing to issue 100,000 pods this season. So the pod line will stay the same line, the same length, but because the bean supply is growing, the pod rate will start to decrease, and thus will begin the deleveraging. So an extended period of excess demand for soil will start to deleverage Beanstalk in earnest.
Okay, so if there's a 100 million that comes into Beanstalk, then 100 million in pods are issued, but the protocol has grown, and so the ratio, pod rate is declining, even though we have the same amount of debt. Sort of similar to someone who had a $50,000 debt and made $50,000 a year. If they get a raise to $100,000, if they still have $50,000 in debt, their debt to income ratio has gone down.
Yeah, we would just
kinda
amend the
right?
size of that to from 100 million to 100,000, because if $100 million came into Beanstalk, all of the pods would get paid off almost certainly. Now, like Beanstalk does, the way that Beanstalk grows, it wouldn't be the expectation that if for every if $1 million, for example, about $1.5 million that came into Beanstalk in a short period of time around Thanksgiving started that growth cycle. That then around $10 million came into Beanstalk or so, but the bean supply increased by 30 million and the pod line decreased by 15 million. The problem was that there were too many beans sown, and so the pod line itself continued to grow. So going forward, that will not be the case. And exactly as you said, Dumpling, your debt stays the same, but your income doubles. So therefore, you're in a much better position from a debt perspective. So it has a very similar dynamic to that. Exactly right.
Okay, that's great. Thanks for answering Don's question. To you now, Ori.
Sweet, thank you. So pretty basic question, but I haven't been able to wrap my head around it. What are the different, I guess, like for lack of a better word, customer profiles or segments here that's going to drive demand? So when I think of like DAI and MIM, to me they make sense because they're targeting people who want to take on leverage. So that's kind of like their main driver or lever for demand. But I don't know what the analog here is for Bean.
So, in short, we sort of view the economic opportunity opened up by a positive carry, a credit-based stablecoin, as opposed to a negative carry stablecoin, as sort of infinite. And some sort of ideal customer that we've spoken about in the past, the use case we want to enable in crypto, even if on the current ETH mainnet, the gas fees are too high, but the hope is to scale Beanstalk to other blockchains as well with lower gas fees, is to enable people to bet on Sunday football, where people can pull their beans out of the silo, bet on Sunday football, win or lose, and then save some money to bet on Monday on Monday Night Football, and then deposit your beans back in the silo. And throughout the week until Thursday or Sunday, you're now earning passive interest. And that will if we can make that possible, then Beanstalk and Beans basically becomes your credit card, your bank account in general. So what's possible when you have a high yielding positive carry USD bank account that is composable and plug and play into a wide variety of decentralized networks. And anyone with an internet connection and a wallet on any of those networks can access that USD deposit account. Our ideal customer is everybody. And so what Beanstalk and Beanstalk Farms, specifically when we talk about organized effort to get Beanstalk there, there's a lot of work that needs to get done to get there, but the amount of at the risk of repeating ourselves too many times, something we've also said is, when the iPhone came out, if you had proposed that I'd open up my phone and call some stranger to come pick me up and take me to dinner in their car, I would tell you you're crazy, right? So there's sort of an infinite number of incredible use cases that's similar to a game-changing platform like the iPhone. We hope that Beanstalk radically changes what's possible in DeFi.
Cool, thank you. So I guess maybe pushing on that a bit, like to get to there, like you have to have like kind of like one initial, I guess, like very specific type of person you're going after, right? So like, is it the gambler, or I guess like I'm still like,
well, so
like obviously
there's a long path to get there, right?
Yeah.
And in the short term, like if anything, the customer focus is a little bit further down the road. And right now we're still in the bootstrapping phase of bootstrapping the economic mechanism. And if we think about where Beanstalk is at with a high debt level and looking to attract capital to deleverage, ultimately its current optimal client or optimal customer is still people that are looking to invest in the stablecoin model itself, right? Either sow in the field or participate in the silo. And even as the various complex economic mechanisms like stock and seeds becoming liquid and their associated complexities go live, ultimately it will, for the next couple months, like just Beanstalk adding functionality and smaller integrations will be enough to sustain itself at the peg and hopefully attract enough demand to start to deleverage. And ultimately what we believe is that deleveraging is sort of going to be the grand proof of concept that will then open up Beans to a much wider audience. So right now, with such a high debt level, there's still a very niche group of people which are more investor focused. So not necessarily orienting ourselves towards the customer at this moment, but our UX UI team might be shaking their heads and want to come up here and say differently. So if anything, the right thing would be to say that's just not where our focus is at the moment. But there are certainly people at Beanstalk Farms who are starting to think about more sophisticated strategies on that front.
Cool, thank you. That makes sense. So like in the short term, primarily it's like demand driven by yield.
Exactly right.
Cool. Thank you.
Okay, I was going to ask a question on the discussion board from Lightbean. When discussing collateralization versus credit as far as stablecoins, he says Publius was saying that people are unwilling to put their money into collateralization, but he never talked about why people would lock it up in credit. So I was having a little bit of trouble understanding the question, but if you could speak to people's motivations regarding collateralization versus credit with stablecoins.
This will be a short answer, which is there's no need to lock up your capital in Beanstalk other than, I guess, depositing your assets or selling them. But in the case of any collateralized model, DAI, MIM, Liquidity, you're taking more dollars of Ethereum than you want to mint in DAI, MIM, or Liquidity effectively, and now minting stablecoin against those assets. And so you're now, for every dollar that you mint, you're locking up more than $1 of capital. In the case of Beanstalk, if you're buying your beans at $1, that is literally never the case. And furthermore, there's no rent associated with that. Now, something like Liquidity doesn't have rent, so there's only a one-time fee. But in Beanstalk, other than the trading fee to acquire the beans, there's no fee at all and no rent. So it's just a different model entirely that doesn't require any capital to be locked up anywhere unless you want to, put your beans in the silo or in the field to earn interest. But in terms of just having the beans to use, like minting the DAI or the MIM to use, there's no need to lock up any capital anywhere. You just buy the beans.
Okay, great. All right, now we have an open floor if anyone has a question.
I have another one, Publius. You've mentioned a few times, like take for example USDC, where saying it's problematic that there isn't a way to earn interest on USDC in a way that's native to USDC, and you've spoken a lot about how it's being like earning interest is native to the protocol. You can deposit them in the silo and passively earn yield. Could you talk a little bit about why that's important, the like staying within the protocol piece?
So when you think about economics, there's something essential effectively in market theory when you're pricing different assets. There's something essential about the risk-free rate of return. And while there are certainly risks associated with Beanstalk, there's no additional risk that you take by taking your circulating beans and depositing them in the silo effectively. And that's especially the case once the withdrawal time comes down to near zero. And so when we consider how, in comparison to DAI or MIM or USDC, where you have the exposure to the issuer, whether that's the CDP that you're in or Circle, the issuer, in order to earn yield, you're now taking your assets and putting them in another protocol. So there's now more risk and there's exposure there. So that's not a risk-free rate of return. And so when we consider that the goal of Beanstalk is to make Bean the ubiquitous stablecoin of DeFi and to really change the entire structure of the crypto economy, offering that risk-free rate of return is a game changer.
Got it. Yeah, that helps a bunch. Thanks.
Seeing if there are any other questions on the discussion board.
I came with a list. I'm happy to happy to go again.
Yeah, keep them going,
Anyone has
Austin.
anything? I saw J-Dub
Yeah,
just popped up.
Awesome. Yeah, I've got a quick one if that's okay. So Publius, I guess I know we've talked. I don't know if this is a conversation to have now or the DAO meeting, but when it comes to capital coming into Beanstalk and into the protocol, we've talked a little bit. You talked a little bit before about kind of like the retail side, and I think it was Ori that was asking the question about kind of this profile of what that customer might look like, what that user might look like. Obviously one niche thing expanding to everyone in the long term, but could you talk a little bit more about the value of looking at kind of retail? I would say investors, but retail farmers or anyone just kind of coming in off the street, just learning about the protocol and the significance of getting them on board versus institutional capital or some kind of liquidity pool tie in terms of just growing the protocol.
So, from the perspective of Beanstalk, all capital is created equal. Now, in practice, that's not exactly the case because capital that has connections and capital that's willing to devote labor or resources is different than capital that's not, especially in the current state of Beanstalk. And so, without targeting retail versus institutional capital or large capital, there's a lot that can be done to make Beanstalk get in front of more people, and that spans across the investment size, and so stuff that may have a smaller impact or a larger impact, it's hard to tell. Is we're happy to be on podcasts, so maybe as a call to the community, if you have any connections to podcasts, that would be great. In general, there's a lot that can be done here, but it's like the BeaNFTs, which JWW, maybe this was just a Machiavellian ploy for us to talk about your BeaNFTs, but the B2 BeaNFTs, which will soon be announced, hint, hint, wink, wink, which JWW and Where Have You Been have been working really hard to get going. That will hopefully bring more attention and more eyes to Beanstalk, and then at a larger scale, continuing to demonstrate the model and just being at $1 and oscillating above and below $1, and then ultimately deleveraging. Nothing will do more to attract capital than a proof of the model, because the proof is in the pudding. And so we, at least personally, are less focused with targeting an individual demographic than we are about just the model continuing to be refined and improved, and us continuing to try to cultivate a strong organic community through things like this class, and we think the rest will sort of sort itself out, especially at this stage in time. And if anything, when we talk about beans being widely adopted across a ton of different things, the beauty of the mechanism and its simplicity is that all of that can be built on top of Beanstalk by independent parties. The only thing Beanstalk has to worry about is the price and the debt level. And so all of this, while it's in our mind, we're more focused on enabling with the core, getting the core platform right, than we are about implementing it ourselves. So if consumer-focused businesses are appealing to you and you love Beanstalk, that you should apply for a Bean Sprout grant. And Bean Sprout is the accelerator that is hopefully going to get proposed as part of the Q1 budget, which people can read about in the Q1 budget channel. We dropped a proposal there a few days ago, or yesterday, I guess. So hopefully that answers your question.
Yeah, it does. And thank you for the overview. I guess then, just in light of that, just because I'm interested in the protocol responding, I guess, to larger investments, there are probably quite a few people in the audience who weren't here for the pump and dump that happened in September. I know you talked a little bit about it earlier in the call, but would you mind just giving a quick overview of kind of what happened and how the protocol responded to it? I obviously it's shaking out the way that, as you mentioned before, you're expecting it to play out in the long term, but just to give an overview of what happened.
So there is, we'll try to keep it short, especially because we're getting to the hour mark of class. But the long and the short of it is that somehow or some way, Beanstalk went viral on crypto Twitter. And for better or worse, a ton of apes, let's call them, who didn't quite understand Beanstalk, brought with them a ton of capital into Beanstalk over a very short period of time. And so Beanstalk went from a $2.5 million market cap to a $40 million market cap over a couple of hours, and ultimately grew to around a 25 million bean supply, because around 25 million beans or dollars of demand came into Beanstalk and bought beans. So when we talk about Beanstalk growing as little as possible, it literally grew basically as little as possible. But then all of that capital, and one of the members of our Discord said it best. They said all of that capital, all the apes, when they realized they couldn't exploit the protocol, immediately left. And so $20 million of capital came in, and then the majority of it immediately left. And the result was that Beanstalk went through a major dead cycle and had an opportunity to demonstrate at a macro level how the weather mechanism ultimately works. And what happened was, over a month or so, Beanstalk was able to attract billions of dollars of loans from hundreds of lenders in a totally decentralized capacity to ultimately bring the clearing market price back up to $1. And from there, the price oscillated above and below $1 for a month or so until it started to pump around Thanksgiving. And again, because the soil parameter wasn't set as well as it could have been, that didn't ultimately start any sort of deleveraging, and Beanstalk continued to lever up. But that can, like we said, we think that that has been fixed and should not be the case going forward.
Okay.
Thank you.
If we have time for two more, I think we could do DB 3, 4, 5, 6, and then over to Dave. Or if TB is sorting out their mic, maybe we'll do reverse order.
Sure. Hey, it's great to be here, guys. Publius, thank you for letting me speak. And Dumpling, it's been great talking to you over the course of the past day or so. And I'm a newbie.
Just so you know, your picture makes you seem like you're like a 60-year-old British man.
Well, maybe I am.
Fair enough. Fair enough.
Yeah, I'm a big fan of what you guys are doing. I got a chance to jump into the white paper just yesterday. Got a chance to look at some of your work, and it's very inspiring and impressive. The community building, the new hats you're working on, and just the one quick question that I have for you, Publius, and maybe for anyone else on the stage, is AVAX. I've been very blessed to have almost 14,000 people that follow me, and whenever I tweet about something and it's $130 or $140 in gas fees, I get a bunch of DMs from people in Vietnam and in the Philippines saying, I can't afford that. I'm sorry, I can't do that. So Constitution DAO recently launched, and in order to get your assets in and out of Constitution DAO is about $140 to do so. So my question is, has there been any, or is there any potential discussions around being able to get access to Bean on the Avalanche network, or something like Avalanche, maybe Solana, or maybe
Yes.
Matic or something like that? But specifically, my question is about Avalanche.
Yes. So it's a fabulous question. It's been on the mind of our community for a long time. And in the original white paper, we actually stated that we assumed that there would be independent Beanstalk on different blockchains, but the fact that the community stressed so much the desire to have beans on multiple chains has led us to go into like a lot of research into what's available in terms of decentralized cross-chain solutions. And if we had had class 48 hours ago, we would have said, so far we've been horribly disappointed. We haven't found anything even close to up to par where we feel like there's an easy decentralized solution to bridge to something like Avalanche or Solana. But yesterday we had a fabulous call with the Celer team, CELER, and we're incredibly impressed. And obviously it was only one call, but we're highly encouraged at their progress and hope that in the coming months, talking 3 months or so, not a year, like in the next 3 months, hopefully Beanstalk and Beans will be on Avalanche.
Well, that's pretty exciting.
Awesome.
Don't
thanks,
hold
Dave.
us to April 1st. But like that, we're going to be working our asses off to make that happen.
Okay, I'll just put April 1st here in my calendar. Okay, TB.
It's April
did you get
Fool's
my
Day,
working?
guys. So we're setting ourselves up for something fun, regardless.
See, if you want, you could type it out, TB, in the chat. Guys, let's see if I have anything else here. I got a bunch of DMs. Okay, well, we're well over the hour. I think we can probably call it. Want to respect everyone's time. Yeah, thanks for everyone for coming. This was really great. You can look for the Austin will have the notes and the recording up. And we're going to be trying to get a class notes section too. So we'll put if I can figure it out, I'm going to put all the class notes from the previous classes in the class notes. And that'll have a link to the recordings too, so you guys can check out old classes if you haven't listened to all 8 of them. So thanks so much for coming. Any last words, Publius?
To everyone for your questions. This is very excited about what where Beanstalk is and what's to come, and just want to encourage everyone to continue to ask questions and to continue to participate. And if you want to get involved, reach out. So very exciting to have you all here, and we'll talk soon.
And DAO meeting on Thursday, 8:30 Eastern. And if you want to be there for the stand up, that's going to be at 8:15 Eastern. So look forward to that. Okay, thanks everyone.